And welcome back. Applications for home loans to buy houses decrease yet again. This is based on a brand new report that was just announced today, which is May 17th from the MBA. I'm also going to be sharing some more early indications of home buying demand in today's video so we can gauge where U.S. housing market is headed. And with that said, let's begin today's video. So this is a report I go over on the channel on a weekly basis here. Just announced on May 17th from the MBA here. It says total applications for home loans decreased by 5.7% compared to the previous week. And this covers the week ended May 12th. So as you guys all know, applications includes refis plus purchases. So the refi index decreased 8% from the previous week and was down 43% from the same week 1 year ago. Meanwhile, though, the seasonally adjusted purchase index fell 4.8% from a week ago and was down 26% from the same week in 2022. What they don't mention in this report right here is that purchase applications dropped to the lowest pre-COVID levels going back to February of 2015. According to Joel Kahn, who's the MBA's Vice President and Deputy Chief Economist, he said that application activity slowed as most mortgage rates in the survey actually increased last week, with a 30-year fixed rate jumping 9 basis points to the highest level in 2 months at 6.57%. So the MBA, as well as Freddie Mac, as well as the Mortgage News Daily, all have different rates they publish. So Freddie Mac and the MBA published weekly data or weekly surveys, whereas of course the Mortgage News Daily reports daily rates for mortgage rates. So according to the MBA here, rates actually increased to the highest levels in 2 months. And that chart is right here, the MBA's weekly survey regarding average 30-year fixed rates for people with exceptional credit, of course. So the current rate at 6.57% is the highest levels going back to March 15th this year. In other words, a 2-month high. However, like I mentioned though, when looking at daily rates, it's actually just the opposite story here, because according to the Mortgage News Daily, average rates today, which is again is May 17th, average rates are at 6.7% on average. 1 year ago, it was at 5.45%. That's an increase of 1.25 percentage points. So daily rates at 6.7% are actually the highest levels going back to approximately right there, which is May 1st when rates average at 6.73%. So when looking at daily rates, we're at the highest levels in approximately 2 weeks, whereas looking at weekly survey results from the MBA, we're the highest rates in the last 2 months. That's one reason why I really like to look at daily rates according to the Mortgage News Daily and not weekly rates from Freddie Mac or the MBA. So going back to the MBA's report here, it says purchase applications decreased 5% to the lowest levels or lowest pace in about a month, as buyers remain very wary of rate volatility, but also for low inventory levels for existing houses as well. So typically when we talk about how the fluctuations in rates, how that's impacting buyers right now, I typically talk about how an average housing payment for approximately a $450,000 house compares to years past. So in today's video, I actually want to take a different take on this though, because I actually want to look at the total number of interest paid based on current rates today compared to rates at 3% that we saw back in 2020 as well as 2021. So let's assume someone's getting a $400,000 loan back in 2020 and 2021 when the average rate was 3%. That would give you a P&I payment of principal and interest of $1,686 per month. Now look at what it looks like when looking at rates today at 6.7%, again, for the same $400,000 loan balance. Your new housing payment would be a whopping $2,581 per month. This means your average housing payment just increased by $900 because rates went from 3% to 6.7%. But wait, there's more. Because rates went from 3% to approximately 6.7%, you're going to pay approximately $322,000 more in interest paid over the life of that 30-year loan. So the total number of interest paid at 6.7% is $529,000. When looking at interest paid at 3%, it's only $207,000. And of course, that's approximately half of the original loan balance of $400,000, whereas at 6.7%, you're paying $529,000, which is far higher than your original loan balance of $400,000. Also, have a look at this because the interest rate is so high right now compared to the past several years here. Look at the amount of principal paid. So at 3% during the first year, assuming your first payment is in May this year, you would pay off approximately $4,841 of your loan balance in 2023. When you have a rate at 6.7% though, you only paid off about $2,475,000. Look at 2025. 2025 at 6.7%, you paid off $11,734. When looking at 2025 at 3%, you paid off $22,096. And this is approximately double the principal balance paid off compared to the rate at 6.7%, approximately $12,000 paid off. When looking at the actual payments each month in the first year, you can really see the differences here because in the first payment, let's just call it June actually. So June 2023, for your first housing payment, again, your housing payment is $1,686 based on a 3% rate. You would pay off $686 towards your principal and pay around $1,000 in interest. Look at this table though, when rates increase to 6.7%. Principal balance paid off only $347, and you're paying a whopping $2,233 in interest for that first payment. So big picture here, because rates increased from 3% to 6.7%, almost fell off my chair here. This is one big reason why you're not paying off as much principal when your rate went from 3% to 6.7%. So if you guys are looking to buy a house, just something to keep in mind that when you're looking to buy a house, you're really not paying off much principal, especially in the early years of that loan. Okay, let's change gears here and talk about real estate showings across North America according to Showing Time. So for the week ended May 16th, the most recent data we have for this year, we have a 17.5% increase in the number of real estate showings compared to the first week this year. Last year, we saw a 13.1% compared to the first week that year. Back in 2021, big difference, a 42% increase compared to the first week of 2021. So let me just actually exclude 2021 so we compare this year compared to last year. So when looking at real estate showings compared to last year, we've had more real estate showings compared to last year ever since really April 15th. And thereafter, more real estate showings compared to 2022. So we do have more real estate showings, but that has not translated to more contracts being signed. So here's the most recent data we have from Redfin regarding pending home sales, which of course is a measure of home sellers and buyers getting offers accepted, or home buyers getting their offer accepted here. Signed contracts for existing houses. So pending home sales are down 16.8% for the forward period ending April 30th this year. So approximately 17% fewer contracts being signed between buyers and sellers, despite the fact that home showings are actually up compared to last year's levels. Additionally, closed home sales are also lagging behind the past couple of years as well, down 21.3%. Approximately 70,000 closed home sales for the 4 weeks ended April 30th. Back at this time last year, there's approximately 89,000, and back in 2021, there was around 95,000. Lastly, one more thing I want to share with you guys regarding some early indications of home buying demand is this right here. This is Google Trends for the amount of people searching for homes for sale on Google here. So the index is at 83. 1 year ago, it was 86. So in other words, approximately same number of Google searches for homes for sale right now compared to 12 months ago. Also, the number of people searching for houses for sale has been relatively flat ever since mid-February this year. And with that said, hope you guys have an awesome day. I appreciate you, and we'll see you on the next video.